Hi, and welcome to Finance Solutions TV. In this episode, I'm going to explain exactly what mortgage protection is and the type of cover it provides. When I meet most clients, they are familiar with the terms mortgage protection and, of course, life assurance, but they're unsure as to whether they are different products or one and the same thing. A mortgage protection policy is only required at the time of taking out a mortgage. It is a requirement of the bank or building society that is providing you with the mortgage that you must have a policy that pays off your mortgage should you or your partner in a joint application die during the term of the mortgage. Basically, the bank want to be protected for their investment and want their money back. If you die during the term of your plan, whatever is left off your mortgage will be paid off, as long as your mortgage repayments are up to date and your mortgage interest rate has not, on average, risen above the rate assumed. The interest rate that is assumed is generally taken at 6%, but there is an option of 8% too. If you take current rates available in the market today in October 2012, your average interest rate is 4.5%. So a protection policy that has a rate of 6% means that you will be paying off your mortgage quicker than your protection policy is decreasing, meaning there should always be enough to pay off your mortgage should you die. Normally, you will transfer ownership of the mortgage protection plan to your mortgage lender, and as you pay off your mortgage, your cover will fall to reflect the reducing amount you owe in your mortgage. The fact that the level of cover reduces over the term of your plan helps to keep the cost of this plan lower than other forms of life assurance. So that's the basics of the mortgage protection policy. Therefore, it's the perfect product to cover yourself and the bank. It's the cheapest form of life assurance, but it does raise the question, is it sufficient to just have mortgage protection cover in place? Well, there isn't a yes or no answer. It very much depends on your circumstances. If you're a single applicant, for example, with no dependents and no one who would depend on your income, then it is without question sufficient for your life insurance requirements. However, you may want to consider serious illness cover, and we deal with that in another episode which you can find on the website under serious illness cover. As a couple, however, the answer is different, and in my opinion, a mortgage protection policy would not be sufficient, particularly where there may be dependents. The minimum requirement, if one in a couple should pass away, is that the mortgage is cleared. But if there are children, then this will simply not be sufficient. Imagine a scenario where one day you had an income coming into the house and the next day that income is gone. Yes, the mortgage will be cleared, but will you be financially secure if that scenario arose? My experience is most people answer that question as no. I go into other options that are available in later episodes, so take a look at the episode on level term cover and completing your financial review for further information. I hope that's given you a good insight into what mortgage protection is and what it covers. And of course, if you'd like a brochure or any further information on this plan, please don't hesitate to call or email me directly. Once again, many thanks for watching Finance Solutions TV, and I'll see you in the next episode.